Hello and welcome to another episode of Construction Corner Podcast. I'm Dylan. I'm your host, and I got a new office, which is cool. You're not seeing it because we're not on video, but it's pretty sweet. Got it all set up and whatnot. But Matt and I are back on the mics for our. I think we're booked to like June right now with guests, so we're gonna keep bringing you guys a ton of guests. Matt, how are you, man?
I'm doing good. We're running away from windstorms here today, but it's all good, man. I'm glad to see you in a proper office finally. It looks nice.
Man, it's one of those things like you just get so used to like I worked at the kitchen table for years, like you get used to not needing a lot of stuff. And
Yeah.
then just over time, like moved a bunch of crap out, got permission to do stuff in a spare bedroom over the last year. Now moving up to the office and getting some other space, especially as we do more of these. Like I need a real recording space for the podcast. So
And speaking of proper kick-ass office, that's a good segue to our guest. I'll let you intro him, but he's got a hell of an office behind him.
yeah,
Thanks.
yeah, I love the setup, man. I got my two bookcases that are I think pretty much full. But all right, guys, without further ado, Jose Ramirez is our guest today. He's founder and chief tax strategist. So we moved Jose up in our queue because it's tax season for everybody out there, and we need to get these out to you before you file your taxes, so we can save you a bunch of money. So Jose is Advanced Tax Advisors founder, CEO, and an expert at implementing tax saving strategies for business owners, landlords, and real estate investors. Again, that's why he's here today. So, as a tax strategist, saved his clients millions in taxes over the years using strategies such as cost segregation reports, accelerated depreciation, bonus depreciation, right tax entities, multiple tax entities, income shifting, Augusta rule. Like, there's all this other stuff that we'll find out more about today from Jose's 23 years of business experience and mostly in management and accounting, with the last 9 years dedicated to protecting individuals and businesses from the dreaded IRS. He's invited to speak at local real estate associations, business-related events, and expos on tax topics, including Trump's tax cuts, Jobs Act, cost segregation, tax planning strategies, all that kind of good stuff. Represented people in front of the IRS and settled a tax debt of over $7 million for around 21 grand, which we should get into that, helping his clients get tax liens released. On and on. I mean, Jose, you've got an impressive resume here. You're an enrolled agent, federally licensed to represent clients from the IRS. And former president of the Florida Society of Enrolled Agents, Broward chapter 2019 through 2020, which is South Florida and the Fort Lauderdale area. Member of the American Society of Tax Problem Solvers and National Tax Practice Institute Fellow. All right, that's a mouthful. And so with that,
Wow.
Jose, welcome to the show.
Thank you. Thank you. Glad to be here. Yeah, that sounded like a mouthful. That was a lot to say. Yeah. Thank you for that intro.
Well, we're glad we could have you on, Jose. We kind of talked a little bit ago in our, off mic about what we usually do. And, we have a lot of construction guys, we got a lot of design consultants, but what we're really trying to do this season, this year especially, is bring in new and different guests that really can provide value for our listening audience. And when we talked, Dylan and I chatted afterwards and we're like, man, that guy's perfect. Let's get him on right away. So welcome to the show, man.
That's great. Thank you. I appreciate that. Glad to be here. I'm sure we can provide some value to the listeners, some tax strategies that we're going to talk about and get into. So glad to be here.
Go. Well, I'll jump right in then. How did you get started in your business? How did you get started in accounting and tax strategy? It's one of those things that frankly scares me to death. So I'm interested to hear how somebody would like that sort of thing. And I mean that respectfully.
Sure. No, you have to have the mind for it, right? I guess I started when I was 20 years old. I started working at a law firm in the accounting department, and at the same time I was going to college. I was still in school, and I figured, I'm already working in accounting, so why don't I just go to business and accounting, right? and then years later, 10 years later, I've already done, I was a senior accountant for a publicly traded company. I've managed businesses from $5 million to $100 million in revenues as a financial controller. And I also invested in real estate. All these years, I had always been investing in real estate. And I had a kind of a wake up moment where I said, this accounting thing is great, but I'm sure I could be doing a lot more in the tax area, because I had an issue in 2012 where I got hit with a $68,000 tax bill unexpectedly.
Ouch.
And I had to learn how to figure out what was wrong with my taxes, right? Because as a financial accountant, as a regular accountant, a CPA that doesn't specialize, or somebody that doesn't specialize in taxation, you can make a lot of mistakes in your taxes, right? But once you transition over into taxation and you learn the industry that you're in, you can actually save a lot of money in taxes. So the guy that was preparing my taxes back then in 2012 made a lot of mistakes, right? So I reached out to a colleague of mine at that time, and I got a second opinion. And my colleague said, okay, you have a loss here. This is not the way it's supposed to be. He fixed it for me, and he taught me what he did. And I said to myself, this is amazing. If I just learned the tax code, I can help so many people. I can help people around me that were in real estate, especially around 2008, when a lot of people lost a lot of property. And that's when, taxation became my mission. And I just learned everything there was to know about real estate within the taxation industry. And, here we are.
It's a great road to take, man.
Mm-hmm. Yeah.
What kind of real estate were you investing in, or are you in, if you don't mind sharing?
Residential, primarily, multifamily, residential, condos.
Nice.
I've done Airbnb, but that seems to be a lot of work, so I kind of went away from that. But I'm still into the single families, multifamilies to this day. I'm getting into a little bit of development, but that's a lot of work too. Being that I run a firm, it's kind of hard to do it all. So I'm sticking to the passive things. I just invest in real estate and let it pay for itself, right?
That's a great way to do it, and I'm sure that
Yeah.
resonates with a lot of people listening today.
Right. Yeah.
Yeah, it's I mean, one, the big, I don't know how big that book, respect books, it's a lot of things that
It's
people
huge.
don't really read. And that's, going back to like the 90s and stuff. I finished up one of Trump's books here recently, and that was how he he didn't go broke and he didn't go bankrupt, but how he lost a ton of money was from a tax code change in the early 90s and how real estate depreciation was assessed. And so maybe speak a little bit to, because the IRS has that ability to go back 3 years and make changes as they deem necessary and change the rules as they go, which to me is just absolutely insane and ridiculous that you never know what rules you're playing by, which again is just I can't wrap my mind around it.
Yeah,
So,
normally they have three. Yeah, so normally they have up to 3 years to audit you, and they don't. The funny thing is that they don't need a reason to audit you, right? They can just pick your name out of a hat and say, you know what, we're gonna audit Dillon today. Let's see what's going on with his tax return. And if that happens to you, you got to be sure that you have receipts. You're saving all your receipts, all your invoices for whatever it is that you're claiming on your business tax return and your personal, right? Beyond the 3 years, it doesn't really happen. Only if you're suspected of fraud, they can go back unlimited years, right? But again, that's also hard to prove, in my opinion. So 3 years is the go-to, right? 3 years is the number that you want to keep in mind.
Well, that's on audit, but I'm also saying that like for some of these depreciation rates, they can change it. They can go back and retroactively change those, the rates, like they can cover the loopholes and those pieces.
No, I don't believe they can go back and retroactively and change depreciation rates. So since the new tax laws, Trump's changes, right, in 2017, we had bonus depreciation at the rate of 50%. And that jumped to 100% from September 27th, 2017, all the way through January 1st, 2023. So January 1st, 2023, it changes from 100% to 80%. So it dropped a little bit, right? And that's going to keep changing every year, 20% less each year until it gets down to zero. But by then, you know, there's going to be new laws coming up with the next president anyway. So we'll see what happens. Depreciation has always been a huge component of real estate, right? It has always been the go-to strategy for real estate investors, because if you buy a building for $1 million, you're not coming out of pocket $1 million normally, right? You're buying it with a loan. So let's just say that you put 10% into the building, you're out of pocket 100,000, but you get to depreciate the $1 million minus the land, right? So the depreciation could be more than what you put into the property, and the tax benefits are huge. And a lot of people qualify for these benefits as long as you're considered to be a real estate professional, which construction happens to be one of the categories that qualifies, right? Which is kind of why I thought it would be a good idea to be here and explain this to your audience, because a lot of your audience are construction people, construction workers, or construction companies that qualify for the real estate professional status. So there's tremendous opportunity there. There's tremendous, if they are doing, in addition to the construction business that they have, if they are landlords and buying buildings, buying property to hold long term, those properties can produce losses. And those losses potentially could be applied towards your ordinary income from the construction company if you qualify, right? There's some qualification tests that we have to go through, but if you do, the benefits are tremendous.
Can we expand? Can you expand upon that qualifications? I don't want to milk you for too much free advice,
Sure.
but
No, it's fine. Yeah. So yeah, there's two quantitative tests, right? The two tests are, you have to have more than 750 hours in the real estate industry, right? Which could be, you could be brokering deals, you can be developing property, redeveloping, construction, reconstruction, acquisition, conversion, rentals, operations, management, leasing. All those categories fit into the real estate professional status. Also, the second test is that more than 50% of your personal services have to be in the real estate industry or trade, right? So in other words, you can't be a full-time teacher and be a real estate person part-time, or you can't be a full-time teacher and be a full-time real estate person, because most likely you can't do both full-time, right? The majority of your time has to be, you could be a part-time teacher and a full-time real estate investor, right? Or a full-time construction company person, right? So those are the two tests, right? Then you have to materially participate in the rental activity. So if you have multiple rentals, you have multiple buildings, multiple multifamilies, you have to materially participate in the activity of the management of that rental to qualify for the elevation of the passive losses to non-passive losses. Now, let's just say that your rentals produce a $300,000 loss here on this hand, right? Because rentals produce losses, right? We have depreciation that can eat up a lot of the income and produce a loss. So let's say you have multiple, and collectively, those rentals produce a loss of $300,000. Now you have your construction business, right? You're doing construction, and that construction business is netting you $300,000. If you qualify for the strategy, if you qualify for the real estate professional status, and you're materially participating in the rental activity, now you net the two. If you net the two, you have negative 300, positive 300 is zero, right? So how much tax are you paying on zero income?
I love it.
It's great, right? It has to do with planning, right? You just have to keep in mind. So I always have, it's funny, I always have conversations with my clients towards the end of the year, usually around November, December, October, November, December. And the conversation always goes like this. All right, Matt, you are going to owe an additional $70,000 in taxes this year. Would you rather take that $70,000 in taxes and apply it towards a down payment on a multifamily, or do you want to just give that to the IRS? That's what the answer is always going to be, right?
Yeah.
Let's buy a multifamily, Jose. Let's just find it before the year ends, so we can reduce that 70,000 to potentially 20 or even zero, depending on how big the property is. So what we do is we just depreciate the crap out of that property via cost segregation. We do a cost segregation on the property, which identifies components within the property. And now we can apply bonus depreciation at the rate of 100% as of 2022, and 2023 is 80%. So let's just say that a cost segregation identifies components that we can use bonus depreciation on for, in the amount of, I don't know, 100, let's say 100,000, right? 80% of that is depreciable and expensable in the year that you place it in service, so in 2023, right? That is a deduction of $80,000 that you can take against your income, which is huge, right? Because you didn't put $80,000 into the property, most likely, right? You put a lot less. So the tax savings could equal, sometimes it equals your down payment, or the tax savings sometimes are higher than your down payment. So you're almost getting the property for free. And if you think about it, because you're getting a tax refund, or you're not paying the additional tax that you should have been paying to begin with, right? You're getting a tax benefit. You're buying an asset that's producing cash flow, and it's also appreciating over the years. So you get a triple benefit. You get a tax benefit, you get cash flow, and you get appreciation on the asset, right? Just by accumulating real estate. So the more real estate that you accumulate over the years, and you want to keep buying real estate every year, right? Because depreciation eventually runs out. So you have to keep buying real estate, because that's what's going to create the tax advantage, and plus create the long-term wealth that everybody's looking for.
See, Dillon, I knew there was an awesome reason to have this guy on. This is
pretty awesome, right?
This is good stuff, Jose. So does it make a difference if these real estate investments are residential based or commercial, like office versus multifamily, or is it doesn't matter?
All of it applies. If it's real estate, it's depreciable. You know, the only caveat there is that when you buy a piece of property, let's say you pay $1 million, you have to look at the appraisal and see what the appraisal says the land value is, because the land value is not depreciable. You can't depreciate land. So let's just say $1 million, but the land is valued at $200,000. Now you have $800,000 of meat that you can depreciate on that property, right?
Got it.
And then you do a cost segregation. The cost segregation tells you how much you can depreciate via bonus depreciation. It could be, you know, 100,000, 200,000, 300,000 the first year, which is huge, right? Because you're not putting that much money into the property to begin with. So if you do this every year, you're kind of playing a game, right? Every year you're buying, before the year ends, you're buying a building, you're buying a property, depreciating that property so that you don't pay, you lower your taxes, potentially lower your taxes, or not pay any taxes depending on how big the property is, but you do it every year. So instead of gifting your money to the IRS, now you're gifting it to yourself, because you're buying assets for yourself that are growing with the years, right?
So the idea is
very powerful.
Just keep stacking. Devil's advocate here. Eventually the boogeyman catches you, right? Or is that just when you just stop investing and you go underground?
Well, you know, since real estate has been, since these laws have been around since the 80s, I believe. Don't quote me on that, because I wasn't around back then, right, when they did these laws. But the real estate is always going to be one of the most powerful tools for tax savings. Of course, if you qualify for the real estate professional status, that's how these big guys, you know, Robert Kiyosaki, Donald Trump, they don't pay tax because they understand the game. They're mixing their businesses with real estate, so they're reducing their taxable income. You know, will it change in the future? It could. You know, depends on who's in office.
Yeah,
depends on who's changing the laws at that time. But it's been that way for many years. A lot of people in DC are reaping the same benefits that other investors are. So they like these laws, right?
So my question on this is like, okay, so you've got your construction company, right? Or you work for a company that has construction. And like in Matt and I's cases, right, we have our own companies, but to shed and this is more like a liability question, right?
Mm-hmm.
But also in flowing the tax money through, is that when you set up a separate entity to hold your real estate in so that you're not personally liable for that, do all those things end up flowing through to the same balance sheet? Or like, you know, you've got a S corp for your construction company and you've got a LLC for your real estate, you know, does that end up flowing to the same balance sheet to where you can take that, you know, piece, or you just, how does that?
No, that's a great question. So normally what you want is the S corporation is usually the operation, the business that's actually producing the income, the business that has employees, or the business that's actually doing deals with other people or other companies, right? That's the S corporation. That would be the construction company. And real estate would be held under a partnership or an LLC, right? Not the S corp. I don't recommend S corp for for multiple reasons, you don't want to have real estate under an S corp. So separate the two. At the end of the day, when you file your tax return for that partnership holding the asset, you're going to get a K1, and that K1 is going to go over to your 1040. And as long as you, the individual, qualifies for the real estate professional status, there's an election. There's a simple election you have to do on the tax return saying, I'm a real estate professional, so all these losses from my rental are going to be applied towards my income from other businesses, right? As long as you qualify. And it's fairly simple. I mean, you know, you want to keep track of your income and expenses in a separate set of books for everything, because you don't want to, you know, commingle. You don't want to mix things.
Yeah.
But it's pretty straightforward. Yeah.
Man, I wish I had talked to you like 6 months ago for personal reasons, and we can discuss that off air, because I think I'm going to be calling you. But let's kind of switch a little bit. So you've talked about a lot of benefits. You've talked about some pretty freaking amazing things that we can do as real estate professionals in the construction industry.
Mm-hmm.
What's the biggest problem you see entrepreneurs in our space in the construction industry making from a tax perspective?
Man, I see a lot of things. So not having the right entity set up for their business. They're either operating under a single member LLC, overpaying in self-employment tax, or they're holding property under an S corp, which I never recommend doing property under an S corp for multiple reasons. Number one is the IRS doesn't allow more than 25% of a business revenues to be passive under an S corp. S corporations are meant to be used for active businesses activity.
Okay.
And if you do it for 3 years in a row, the IRS can revoke your S corporation election. And if that happens, if the IRS revokes your S corporation election, what would happen is you have to do a termination of the corporation and do what's called a liquidation of assets. So meaning everything that the corporation owns now is distributed to its owners. And if there's assets in there, you're going to be paying capital gains because they're distributed at the fair market value. So you never want to be in that position, right? That could really hurt the owners tax wise. Yeah.
Okay.
That's one reason I can think of. But you know, there's other reasons. I mean, you want to separate the activities, right? Never have the active business attached to the passive to the assets, because liability purposes and things of that nature.
Okay, that's good to know.
Yeah.
So I'm going to keep rolling here.
Yeah, go ahead, please.
So a tax strategist, and this is me being naive. You're not a CPA. You're not an accountant, right? You're not the guy that's going to file my taxes for me. So I can utilize your services, team up with you, and still I need my CPA on the other hand, right? Or do you do all of it?
I actually have CPAs working for me.
Okay.
So we are tax advisors, including my CPAs. So so it's just a different license, right? It's just a license. My license is an EA. I specialize in taxation. A CPA could be an accountant, or could be a tax advisor. They have to decide what area of their field they want to specialize in, right? I used to be an accountant for 13 years before I transitioned over to taxation, right? So now I'm a tax accountant, but I call myself a tax advisor because even though we still prepare returns. I mean, I do very little returns now because I have staff that handles it, but I do more of the consulting and the tax planning for our. So yeah, don't get hung up on the license, because I've heard this before. You know, people generalize things. You know, people generalize, oh, but my CPA is great. All right, why is he so great? People don't even know why they just like him because they like their personality or something. Tell me how much money they saved you this year. Can you talk about that? Well, no, you just prepare my taxes. Well, there's a big difference there, right? An accountant that's focused on compliance, all they're going to do is prepare the tax return. When you're working with a strategist, or when you're working with a tax, you're first going to focus on how to save you money throughout the year before you get to the point of preparing the tax returns. So we do it all, right? We do the compliance, we do the tax planning first. We identify strategies that you may qualify for. And if you don't qualify for strategies, we coach you what to do going forward to qualify in the future, right? And then once you qualify for them, we do it all, soup to nuts, planning, compliance, preparation, even accounting. We have a staff accountant that handles a lot of our clients. Accounting, payroll, traditional services. We're a full service accounting firm, accounting and tax firm.
Okay. Well, that's also good to know.
Yeah.
One more, and then I'll let Dillon speak again because I'm kind of hogging
Sure.
it, Mike. But
Sure.
do you recommend using the same accounting firm, tax strategy firm, your kind of firm, the same firm for both business and personal? Or is it beneficial to kind of bifurcate the two and have like my personal guy here and strictly business folks here?
No, that's a great question. No, I think they're on the same house, because now, the guy that's doing the personal knows what happens with the business, knows what's going on with the business. And there's always basis you got to track, right? The basis, a lot of people business owners don't really understand this, but some do, but I'm just generalizing. But
I
there's
don't.
basis that you got to, sure. So there's basis you got to track in your business, right? If you're an S corporation, if you have I'll give you an example. If you have a net income of 100,000 at the end of the year and you leave that money in the corporation, you don't take it out, you're still going to pay taxes on that money, right?
Yeah.
But if you don't record that on your basis worksheet, right, you have to track your base. That's your equity in the company. If you don't record it, then if you take it out in a future year and you didn't record the fact that you left the money in the company, you can pay taxes again on that money when you take it out. So it's important to know what's going on with the business and the personal, because that is tracked at both levels, the business side and the personal side.
Okay.
So yeah, I would encourage everybody to look for a firm that can handle both. It doesn't make sense to split them up. You want to have a full history and access to all documents and records.
Well, that is great advice, man. I appreciate it.
Yeah. It can be a little technical, and it can put a little, it can put people off, because a lot of people don't understand the technicalities of taxation, all the forms. It could be overwhelming. I mean, when we prepare a tax return, there's like 100 pages in there. I could tell you that most people don't look at all the pages, right?
Yeah.
But it's just a lot to consider. Yeah.
Yeah, I mean, that makes sense to me in having, the same firm provide them, but at the same time, like, well, let me just handle that. So mainly in keeping it, in the same firm, it makes sense in that they know what's taken out, what distributions are happening, what should or shouldn't be distributed from the corporation to the individual, all that kind of stuff. If there needs to be depreciation on, business assets, personal assets, another company. And this is geared for business owners, right? And construction, having where you have multiple entities you got to take care of, going to do, their real estate in. So just to kind of help clear some of this up, right? Some of these more advanced things are going to be for the guys that have, an S corp, multiple LLCs for real estate on the other side, and then
Yeah.
you really need somebody to help combine them to do that. And then if you get big enough, the thing that I always like to remember, looking at like Fortune 500 companies is, they have audits. They have like one of the big four audit them, or some other auditor, just to, everybody makes mistakes, whether we like to admit that or not, but to have those audits when you get big enough to where, you have so much money flowing that, it's always good to have that second set of eyes. And I mean, Fortune 500 companies have them, and Enron still happens. Again, not throwing anybody under the bus, but just,
Totally.
I mean, what your thoughts on that, Jose? I mean, for a W-2 employee versus a business owner that's got, a whole buffet of companies.
Yeah, unfortunately for the employee, the W-2 person, there's not a lot of tax benefits, right? They are the people that are paying the most tax in the country, really. There's nothing you can do about it. You're a W-2 employee. But once you transition into being a business owner, even if you're doing it part-time in the beginning, I mean, there's a lot of deductions you can take, right? I mean, a lot of the activities that you do on a day-to-day basis that are business related can be deducted and should be deducted, right? And as you grow, there's so many strategies we can implement, especially around real estate. The more money you make, the more we can do in terms of, we can buy bigger assets. The business owner can buy bigger assets, bigger buildings, and we can depreciate those buildings a lot quicker, or a lot more of the building, better said, right? So
What's the typical depreciation term, because you're talking about
Sure.
continually buying stuff every year, but what's like the depreciation term that you should, at the end
Right.
of X, you need to sell it, or what happens at the end of that?
Right, because eventually you're going to run out of depreciation, right? So if
Yeah.
it's a residential property, it's going to be 27 and a half years. And if it's a commercial property, it's going to be 39 years. So the catch there, or the thing there to consider, is that when you go to the closing table and you buy a piece of property, all you're getting is a piece of paper called the HUD, right? That shows you how much you pay for the property. So let's just say you pay $375 for a single family home. The HUD is not going to tell you what the land value is. It's not going to tell you what the value of the components are in the property. So you need the appraisal to back out the land, right? Otherwise, you're just going to depreciate the property over 27 and a half years instead of taking bonus depreciation. And then you do a cost segregation. The cost segregation is going to identify the components within the property and assign a value to those components. Once you have those, you can identify what's depreciable now via bonus depreciation and create this loss from your property. So 27 and a half years is the default, right? 39 years is for commercial, 27 and a half for residential. But with a cost segregation, you can do it a lot faster.
And when you're talking about the components, that's like, water heaters, roof, all
Exactly.
those.
Exactly. So you identify the kitchen cabinets, what the value is, you identify what the countertops are, the roof, the appliances, and all those components have a value associated with it. So as long as you know what the values are, now if they qualify for bonus depreciation, we can take those values and expense them, right? So a cost segregation has two benefits. Number one is identifying what qualifies for bonus depreciation. The secondary benefit is going to be the fact that you have a list, a very detailed list of all the components within your property and a value associated with them. See, what most landlords do is they buy the property and eventually they have to fix something. Like eventually they have to replace the roof. But they forget when they replace the roof, all they do is they pay, let's just say that they pay $50,000 for the new roof. They start depreciating that new roof over 27 and a half years, the year that they placed it in service. But they forget that they have the old roof that they removed and discarded, right? So they don't expense that. And they don't really know how to expense it. They don't even think about it. It's not even a thought in their mind. They're just, oh, I got a new roof. But with the cost segregation, now you have a report that says, okay, the original roof was valued at $20,000. So if I no longer have the roof, guess what? I'm going to expense it, right? Because I don't have it anymore. I threw it out. It's garbage. So now I'm going to expense $20,000 plus start depreciating the new roof over 27 and a half years, right? So that's the second benefit of a cost segregation. You can basically do it with all your properties and just have a list of components, and eventually you're going to replace something and you'll be able to expense something, and it'll slot in taxes, right? Let's say in a 35% tax bracket, 37% tax bracket, if that $20,000 scenario, that would have saved you about $7,000 in taxes just by having that report handy.
Yeah,
right?
to say that.
And I can tell you that the report is the cost of the report is insignificant compared to the tax savings.
Right. They threw 20 grand basically
Right.
in the trash. And so, we're going to write that whole thing off. We bought 50 grand. Now we're going to depreciate it.
Right. Over 27 and a half years. But that's a common mistake that landlords make. They don't expense the old asset that they no longer have, that they removed at some point during the time that they owned the property. Yeah,
Jose, you're hired. Send me a contract.
There you go. Excellent. Love to have you.
We'll be talking. Awesome. We'll be talking.
Excellent.
What else do you see out there, Jose? Like what other, we've talked about some of the big ones, depreciation. Obviously, I think a lot of people have heard about it. The expense segregation, that's a big one. I haven't heard before in doing this. Granted, I haven't invested a ton in real estate. We just find it. But what are some of the other, big things that people should be on the look for, or what should they look for in hiring, a tax advisor?
Yeah, that's a great question. And I always talk about this. I do I'm pretty big on videos and social media. And I give a lot of tax tips on my social media and a lot of advice, right? And that's a very common question. What you should be asking your accountant, CPA, EA, even tax attorneys, you should be asking, if you're in real estate, you should be asking them if they understand how to qualify, how they can qualify for the real estate professional status. Another question you should be asking is, do you understand cost segregations and how they work? Do you understand bonus depreciation? right? Do you understand how to elevate passive losses to non-passive losses? If they look at you with the deer in the headlights, you just got to run the other way, right? You got the wrong guy. So just say thank you and walk away. Go to the next guy, right? Because the person that you're working with, the advisor that you're working with, needs to understand your business. If they don't understand your business, they're not going to be able to help you. They're just going to prepare the return, and hopefully they do an okay job. Hopefully they do an okay job so it doesn't get audited, right? To keep you in compliance. But they're not going to help you save money. They're not going to give you the advice. Hey, you should add up your hours and make sure that you qualify for this real estate professional status. Why don't we do a cost segregation on this property? Let's elevate the passive losses to non-passive losses. They're not going to give you that type of advice, right? So that's the difference. So ask the questions, right? If your current CPA doesn't understand these things, you may want to look somewhere else. It doesn't have to be a CPA either. It could be an EA, tax attorneys. I've seen lots of tax attorneys make a lot of mistakes as well. I am big for, working with the people that understand your business, because if they don't understand your business, what's the point, right?
Right. Well, and understand too that tax attorneys are for liability, not for.
Well, yeah, there's some tax attorneys out there preparing taxes. They're out there doing the consulting and the tax planning. But again, the tax code is so big that it's impossible for one individual to know everything, right? It's just too much.
Yeah.
So that's why you have a team, or that's why you specialize in an industry, which is our industry. 90% of our clients are real estate investors, people that are developers, brokers, flippers, wholesalers, contractors, and then the rest, we have a small percentage, 10% are going to be professional business, professional services like lawyers, doctors, engineers, marketing firms. That's a very small percent. The majority is going to be real estate related. So, we're good at that real estate area, in the real estate area, because I've been a real estate investor since 2003, which is how I got started in taxation for real estate, because I had an issue in 2012 and I said, I need to learn this thing. I've been doing this for taxation for 10 years, 13 years in accounting and finance, and then taxation 10 years. So it was kind of like a transition, but it was kind of the same industry, right? All accounting and finance. But then from accounting, I just went to taxation. I thought it was the next step for me, and it's been great since.
Yeah, one of the calls I was on recently, one of the things that we went through is a lot of construction professionals, and making sure that you have specific people dealing with specific portions of your business, right? Making sure that, like, for one of the things that was discussed was in contracts, right? So making sure that you have a contract attorney that specifically deals in contracts, right? Making sure that you have a tax guy that specifically deals with the tax code in the area of business that you're doing, right? And having maybe you need a litigation attorney, maybe you need an HR attorney, like 4 different attorneys, especially in the construction business. You might need a couple different tax advisors, right? Depending on what you're doing. And you've got other consultants around you to really complete that picture. So it's just crucial to make sure that you have the right people on your team that are specialized in each area. And then, kind of combine that advice, if you will, into what's right for each area.
Yeah, absolutely. The bigger you get, the more advisors you need, right? Because you can't do it alone. You need help. Hopefully, most of the audience here is doing things correctly, and you're not really exposed to a lot of liability. You're not exposed to audits and that sort of thing. But I can tell you, I got a couple of attorneys, that I reach out to when I need advice on some things, right? I have an awesome litigator. The guy's a beast. I love that guy. He's actually a good friend of mine. And then another attorney that's more in the contracts, that sort of thing. But you need a team. I also have, I've over the years, I've accumulated mentors, right? And I still keep in touch with one of my mentors, who's a tax attorney out of Cincinnati. And whenever I have a big case, I may work with him, or he may have a case that he may want to work with me. So it's good to have a good team of people that are gonna do the things that you need done, right? Can help you get the things done that you need.
Absolutely. So we're kind of pushing up on time here, but I want to ask one last question. You mentioned you do IRS representation or representing clients in front of the IRS. I'll be honest with you, I have a general distaste and distrust for any of the 3-letter agencies. So give me the quick 30-second spiel of how nerve-wracking is that really to do that?
I mean, it is for the client, right? Because the IRS can be intimidating, but we're professionals. We deal with revenue officers all the time. It's just we have to look at the code, right? We just have to follow the code. If the IRS makes mistakes too, and sometimes we just got to put them in check. Sometimes we just say, hey, no, you can't do that, and then they reverse whatever it is that we're trying to do, right? So it's just a matter of having communication with the IRS. For instance, that case that you guys talked about on my intro, this was a referral that he had a $7 million tax bill. And this guy had been fighting off the IRS on his own because he couldn't afford to hire professional help. And, he came to us, he was distraught. We helped him. We helped him come up with a partial pay installment plan. So we negotiated a partial pay installment plan with the revenue officer. Revenue officer accepted. We said, we're going to pay you roughly $1,500 a month. And the client ended up paying around $1,500 a month for a little bit over a year, maybe about a year. I can't remember. It ended up being about $21,000. And then we were able to get that lien because he had a federal lien on his name with the county. We were able to get it removed from the record.
Wow.
Now, time was on our side because there's also a statute of limitations there that you have to follow. And we were kind of like adamant about, hey, the statute's coming up. Let's just get this paid for now. And then I'll go back to the revenue officer and say, statute's up. You got to remove this lien. This lien is going away. Right. So it's a little bit of, I don't want to say maybe a little bit of luck, but not really. It's just a little bit of planning. Right. We knew that we had time on our side. So it was a great case. I mean, the client was, over the moon. He couldn't believe it.
I bet he was.
Can you imagine having a $7 million bill and then you settle it for about $21,000? It's amazing.
I'd be over the moon would be an understatement.
Yeah. So yeah, it was an interesting case. And our client, we don't really have that need for our clients. Our clients don't get audited, right? But every once in a while, we'll get a referral that somebody needs help, and we'll help them out. Whether it be an offer on compromise, installment agreement, partial pay installment agreement, penalty abatements, things of that nature.
Good to know.
Awesome. Jose, where can everybody find you for more tax strategies, tips, or if they want to get in touch and work with you?
Yeah, no, absolutely. So follow me on Instagram. I'm big on Instagram, Chief Tax Strategist. That's the handle. And then the firm handle is Advanced Tax Advisors. And advancedtaxadvisors.net is my website. If anybody wants to reach out, just click on the link, contact us, and we can be in touch. We can get in touch that way.
Awesome. Jose, I really appreciate you coming on. Guys, you're going to want to listen to this one. I don't often listen to our own episodes, but I'm going to be saving this one and replaying it over and over again. So share the show around for us. Help us spread this out, and definitely reach out to Jose for some tax strategy and tips.
Yeah. Excellent. Well, I was glad that we were able to make this happen, guys. This is great. I mean, I know that we kind of planned it last minute, being that it's tax season. We thought it was going to be great to get it out there pretty quickly. So I'm glad we did this.
Jose, thank you so much for coming on, guys. Share the show if you found this valuable and helpful. I'm sure you did, especially since all of you are in the construction industry. So you're going to qualify for some additional tax savings. So with that, Jose, thank you for coming on. And that's this episode of the Construction Corner Podcast. Until next time.